You've heard about it. Freehold prices are on fire, but rents are still down. So do freehold real estate investments still make sense in Toronto? Let's be upfront and address the elephant in the room. Yes, if rents are down and prices are up, the reality is that rent yields are down from the highs in early 2020. But rent yields are actually just part of the picture. To be fair, we should actually compare how investment returns are now versus how they were like right before COVID. And in this video, I'll talk about just that. Now, before I move on, remember to subscribe to our channel and hit the notification bell. And if you enjoy this video, please give us a thumbs up so that other people who might be interested might be more likely to see this video as well. Let's do a recap of what's been happening from the start of 2020 until today. Toronto real estate was trending upwards right before the pandemic. We had a warmer than normal January and the economy was picking up, so there were a few months of good run at the start of 2020. COVID came, so that stalled prices for a couple of months during the first lockdown, but that did not last long. Prices shot back up quickly in the summer. There was a lot of demand from buyers and sellers after a 2-month stall, plus more buyers were entering the market because interest rates are so low. At the end of 2020, second wave fears started mounting up, so real estate prices took a breather, and now it's on fire again. To sum up, we're looking at around a 15 to 20% year-on-year gain in prices on the freehold side, with lower priced freeholds being closer to the 20% mark. Tenants were also affected by the pandemic, and there were shifts to renters' income, work situations, and choice of home. The end result is that there was a lot more turnover of tenants as there are more options out there now, and the added supply also caused freehold rents to be down 10% year on year. We can take a look at our favorite measure of rent yields, cap rates, which is calculated by taking the rent minus operating expenses divided by the property's market value. Right before COVID, properties that we invested in had cap rates closer to 5%, but now they've compressed to around 4% for a similar price starter freehold investment property in Toronto. Now, if you look strictly at cap rates or rent yields, real estate investments do look less attractive, but again, this is not the only element of real estate returns. The main reason why people continue to buy is because interest rates are sitting at all-time lows right now. 5-year fixed rates in early 2020 was around 3%. Now, 5-year fixed rates are almost cut in half at 1.6%. This is great news for end-user buyers. With the same monthly mortgage payment of $2,700, before you can only afford a house that was at $800,000 because rates were at 3%. But now, $2,700 each month translates to a property that costs $965,000. People can't afford to buy a more expensive house, so that's why property prices continue to go up. This is also the reason why real estate investors continue to pour into the freehold investment market as we speak today. Essentially, we're getting free money to invest in after adjusting for inflation. In terms of numbers, we were looking at $900 of positive cash flows before, whereas now we're closer to $550 per month. It's more accurate to compare returns as a percentage of capital since property prices are different. So the ROI portion from cash flows went from 5.8% pre-COVID to 2.9% for a property that's on the market now. Cash flows are lower now, but it's only a portion of your total returns. The most important thing is that cash flows continue to be positive so that you're not taking money out of pocket to sustain the investment each month. And this makes freehold investments a more stable investment. We also have equity pay down, and there's a difference here as well because rates have dropped. If you're on a fixed rate mortgage, your monthly payment is fixed throughout your entire term. And because you have a bigger loan at the start, your interest would be higher, making the principal percentage of your monthly payment lower. As you pay down your loan each month, the principal percentage of your monthly payment will increase over time. Now, because interest rates have dropped, the principal portion of your monthly payments at 1.6% right now at the start are actually higher than when the rates were at 3%. In other words, you build up equity faster when your rates are lower, and you can see this more obviously by looking at the equity gain portion of the ROI. The year one equity gain portion of the ROI pre-COVID was 7.2%, whereas now the equity gain is higher at 9%. Appreciation is the last piece of the ROI puzzle. Different people have different opinions of what's going to happen, so to make things simple, I'll just assume that the long-term appreciation rates are similar for both pre-COVID and now. This means that the appreciation portion of the ROI remains the same. If we use 3% appreciation, the appreciation ROI would be around 13% for both cases. And because appreciation doesn't really make a difference, it really comes down to the changes in cash flows and changes to equity gain. And when you tally things up, the net change pre-COVID versus now isn't all that different. We're looking at a total ROI of 25.9% pre-COVID versus 24.7% now. Basically, Freehold investments continue to have stable, attractive returns, and it's still safe because they remain cash flow positive. A lot of things can happen in the future, and these numbers are definitely not set in stone. For example, rates can go up. This isn't expected until closer to 2023, and even at that point, it's still expected to be gradual. And when rates go up, the economy is likely to be picking up again, so rents are likely to erase the 10% declines, which can continue to balance cash flows and equity gain. And if you're wondering what we think of future appreciation, we continue to be strong believers in Toronto real estate. Historically, Toronto's seen the best long-term appreciation compared to the rest of the GTA because Toronto is the most desirable place to live in the long run. When you look at post-COVID appreciation, Toronto freeholds haven't jumped as drastically as the suburbs. When you combine this with the added demand once immigration picks up again and more people go back to work, we believe that Toronto will see better, more stable rates of appreciation compared to the rest of the GTA moving forward. One final note is that this comparison is specifically for freeholds in Toronto. Condos are a bit different since prices went down, not up, and rents went further down. Toronto condos deserve a separate video on its own, so stay tuned for another video about that. If you're just starting out with real estate investing in Toronto, we're happy to chat to learn more about you, educate you on real estate investment basics, and eventually help you get that first investment property. If you're currently a real estate investor and you're looking to grow your investment portfolio, we also want to help you out. We can review your current portfolio and give you recommendations on how to optimize it so that you can grow your returns more effectively. And if time is an issue, we have other services like leasing and property management to help you out. You can connect with us by heading to the link I'll put in the description below. Thank you for watching this video until the end, and remember to like this video if you haven't done so already. Remember to subscribe to our channel, follow us on Facebook, Instagram, or LinkedIn by searching @ElevateRealtyCA, and share this video with anyone who might find this video useful as well. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.